Hi, I'm Brad Rosley. Thanks for tuning in today to Smart Money. Today, in the spirit of giving, I'm going to share with you some tax planning strategy that could help a lot of people. It's not for everybody, however. It's for people that are over age 70 and a half. And while that may not be you, it could certainly be your parent or your grandparent. So do them a favor and listen in. Share this with them because it's a great, easy tax saving strategy for a lot of people. Today's tax strategy is something that's called a qualified charitable deduction. So if you know somebody or you are someone that's over age 70, has an IRA account, and makes charitable contributions to a church or charity, you really want to tune into this. And I can't ask you enough to share this with someone else you know who may be in that situation. Also, as a reminder to go ahead and hit the subscribe button so you get this and future tax saving videos on YouTube. So today's qualified charitable deduction, also known as a QCD, if you look up the term. What this means is, and it only relates to people over 70 to have an IRA. And the reason for that is the tax law allows for people that have to take what's called a required minimum distribution, RMD. Required minimum distribution from their IRA account, which the government mandates you do after the individual turns age 70 and a half. There's a calculation for that distribution. Roughly in year one, it's approximately 4%, just under that, of your prior year balance. So for example, if you or your parent or grandparent had a $100,000 balance at the end of 2017 on 12/31/17, there's a multiplier in a table where you can look up, and I've written about this as well, where you can calculate how much you'd have to take out of your IRA by the end of the year. And let's just say, for example, it's $4,000. That's your RMD for the first year, a $100,000 balance. Each year after that, by the way, the percentage slowly goes up, so the amount you have to take out as a percentage is increasing. So that $4,000 is added on to your taxable income at the end of the year when you do your tax return. Now, if the person in that situation was also giving $4,000 or more to qualified charities throughout the year, there's something they should be looking into, and that's this QCD, the Qualified Charitable Distribution. Instead of taking the $4,000 from their IRA account and then making their contribution out of their bank account like they always have, there's a tax-savvy move, and that is to have the IRA money from what's called their custodian give the money directly to the church or charity. This is a huge tax saver for anybody who makes good-sized donations every year. So to keep it simple, let's just say you did a $4,000 donation in year one with your $100,000 RMD from your IRA. Well, if you had to pay tax on that $4,000, depending on what tax bracket that you're in, it's probably somewhere from a minimum of 10% up to 22%. So that would save between $400 and $800 in taxes on just by using this little strategy. So you'd have the check made payable to, not to you, but to the church or the charity. It's actually sent to you, and then you give it to the church or charity. Then you do not have to pay federal income tax on that money. It's really that simple. Again, the keys are this. It has to be a RMD, required minimum distribution. The only people that have those are those who are over age 70 and a half that have IRAs. So if you're under 70 and a half, this does not apply to you, although it certainly could apply to your parent or grandparent. It also only applies to distributions and donations that are made to qualified, what's called 501c3 charities. So it has to be a qualified charity. Most churches are included in that, and most large charitable organizations will fall under that umbrella. There is a limit to the amount that you can do, and that limit's $100,000 per year. It's quite a sizable limit. But as you might imagine, a lot of churches and charities receive donations every year from senior citizens that are quite large. And those senior citizens are not aware of this. So please, please, please make them aware. One more time, the Qualified Charitable Distribution. You're over 70.5 years old. You're taking a required minimum distribution from your IRA up to $100,000 a year. Okay, you can only do this with your RMD. So if your RMD is $5,000, you can do this with $5,000. You can't do that. Even if you donate more than the $5,000, that's great, but you're not likely to get this. You will not get this tax deduction, if you will. It's not a deduction. You do not have to pay income tax on the money in which you make this distribution to that church or charity. So let's look at another example. Let's say you have $1 million IRA and you're 76 years old. Well, now your RMD is somewhere near $46,000. That means that up to $46,000 of your donations in that calendar year, you wouldn't have to pay any income tax on. Well, now we're talking about saving $4,000 to $8,000 a year in income tax. Always consult with your tax advisor on this before doing it, and as well as when you file your tax return to make sure you do it correctly. Thanks for listening. Again, another reminder, please share this video. I also have a blog at bradrosley.com where you can look up the article that gives you the written information on this and many, many, many more strategies and different articles that I've written. bradrosley.com. Subscribe to the YouTube site. Thanks a lot for listening. Have a great day.